Oh wow, this one you can really see, that's pretty. 50K rehab and then 150K purchase. Alright, 212, we're going to be 3.9 and 13.9. That's going to equal 1.2 a month. Alright, our loan amount is going to be 175. So 4 points on 175 for 15,370. So what I do is I do 13.9% as the annual interest, which is a little less than 1.2% a month. I'm always going to bump it up to give them a little more. I'd rather overestimate than underestimate. So again, if we have 175, we said 1% is what? 1750. So what's a tenth of a percent? 175 bucks. So 350 and 1750 and 250 is 2,000. So that's 2,100 a month. Plus cut the grass, electric bill, blah 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 blah. 2,250, give or take, monthly. So that's your points and your interest. And then you got your sale, right? So I'll just put that down here. And we'll do 3% and 1%. And then you got 1% and 1%. All right. Okay. So on the positive side, you're going to have your hard money loan of 175K. Let's switch it up. And then you're going to have your own cash. And right now that's a question mark, okay? On the cost side, you got the purchase price, 150 grand. You got the rehab of 50K. And you explain how that works in an escrow account. I'm not going to do that here. You've got your points of $7,000, maybe $7,500 with an appraisal, etc. Points and costs on the hard money loan. And then you have physical insurance, right? Because everything's all in now. So physical insurance is going to be roughly $1,000. So you have $207,500. You have $207,000, $208,500. That's your all in. And so down here you're going to do 25, you're going to do 33,500, and that's going to give you 208,500. Everybody follow me there? Super simple, right? Now whether you buy, fix, and sell, or buy, fix, and rent, at this point, you're at the same spot. So now you're going to buy, fix, and sell. Typical carrying time on a buy, fix, and sell.
4 months.
4 months. 4 months times 2,250. Anyway, $9,000. So. And that's, remember, we put a little bit in there for grass and all that crap. So $9,000. So that's going to give you $217,500. All right, now you're going to resell it. You're going to resell it for $250,000. You're going to have 3% to a buyer's agent. You're going to have 1% minimum to us as a listing agent. Maybe they go with a flat fee, that's fine, but worst case scenario, let's just call it 1%. All right? These two, closing costs and buyer's title policy. Okay? I tell buyers, when you get above the $250,000, $300,000 price range, these become very negotiable. Below that, you may have to pay it to help a buyer close a property depending on what kind of cash they have during the closing. All right? But with a buy, fix, sell versus buy, fix, rent pitch, I'm going to give you every benefit. I'm going to say you didn't even have to pay those 2%. Okay? So here's 4% in commission. What's 4% of $250,000? Thank you. $10,000. So you're going to pay 10K commissions, and you're all in at 227, let's just call it 227 for nice round numbers. So your profit as a buy, fix, and sell is $23,000. What's your investment, total investment? Anyone understand? Anyone TP, total profit? Anyone know what your total investment is here?
42,500.
Very good. 33.5 and the carry cost, right? Those are the only two things that come out of your pocket. This goes to get you to closing. This comes out of the sale price. This comes out of your pocket. Everybody follow that? Okay. So if you have 33.5 and 9K, that's going to be 42.5. So you made 23 on 42.5 invested. Total investment.
Wait, isn't the carrying cost realized when the property sells, or is it out of pocket when you close on the property?
Not when you close, but over the course of that 4 months while you own the property, you have to pay that out. Then you recoup it out of the 250. So this is a really good question, and I say that because you're going to get people who come in and see this, and they're either not sure where their carrying costs are coming from, or they're not sure how this 10 grand is being paid if it's not being paid out of pocket, or even worse, but it doesn't really matter. They can't figure out how they're getting their fucking money back. Like they're like, oh, I gave you $33,000. How am I getting that back? Yes, sir.
So with the carry cost, do you also need to add in 10 grand to cover rehab expenses until the bank will reimburse you?
Yeah, it's a net wash. Like, yes, you're going to have that in reserves, so they need to have more than 42.5. They really need to have 50, 60 grand in the bank to do this project, right? Because they're going to have to draw and then pull it back. But as far as the cost goes, at the end of the day, it's going to be the same because they're going to pull it back.
Okay.
So what I do to show everybody how this works, if they have questions like, hey man, how do I get my interest back, or where's that coming from, is I just back it out. I go, hey man, you sold for $250, right? What's the first thing that they're going to do?
Pay the loan.
Pay the loan. So let's take out 175 grand. So what's that leave? 75 grand. Okay, what'd you bring to the table? 33.5. Let's pay yourself back. Very good. So let's see, what's that? That's going to be 21.5. So that leaves 21.5. Is that right? I did that wrong. Sorry, I did that wrong. That's going to be 41.5. Right? 74, yes. Okay, so 41.5. How much did you have in carry costs? 9 grand. So take that back. That's going to be 32.5. And what do we say you made? 23K? You got 10K in commissions, right? That's 22.5. And if you remember, we gave you 500 back right there. So it's 23K, and that's 23K. And you show them how everything comes back to them. All right? So if anybody ever gets confused, just start with the sale price and start paying everybody back. And, okay, now it makes sense. All right? So, you do your flip, and you have roughly a 50% return on investment, right? 50% would be, what, 21,250? So you're a little bit above that, so let's call it a 51%. It's a little bit below that. So let's say 51% return on investment. Now let's say you took that 23K and you reinvested it, in some other investment, right? What's a decent return in any other investment, or even in a piece of real estate if they put that into a cap rate? What's a good return?
8% annually.
8, 10, those are great returns, right? So I'm going to give you 20% on that investment. Over the next 5 years, because we're going to look at the rental over 5 years so that you can see how the tax benefits add up. All right, 20% over 5 years non-compounding is what percent return? 100% return, right? So if you have a 20% for 5 years and you had 23K, at the end of 5 years, you're going to have $46,000. Okay? Now, let's come back to the closing table. Now let's do it as a rental. Okay? How many months is it going to take you on a bridge to perm to do this? 60 days. So 2 months times 2250. Let's just call it 40. Well, let's call it 4,500 bucks. There's 500 at the end, drive me crazy. So 209. So that's going to be 213, right? And are you going to have any sale cost as far as commissions or anything like that? And with our bridge to perm, there's Very little cost on the refi. It's not like you have to pay a point and then do all the shit. I think you have to get an appraisal, and that's about it. So even if you said there was $500 there, you put it at $5,000, and you're at 213.5. Okay, call it 214.
Wait, is that with the points?
That's with everything, yeah. There's no second points. You're just gonna have to do a new appraisal.
Okay.
Now, if they go to some other random lender, they may charge them half a
Yeah.
point to a point on origination, which is really only gonna be, if you're pulling out 80% of the 250 even, it's a couple grand, right? So maybe we're $1,000 off on the worst case scenario. And honestly, you can even give it to them. You go, fuck it, 215, fine, let's call it 215. And this is my whole point with this is, I will give you every benefit on the buy, fix, and sell. And I will take every disadvantage on the buy, fix, and rent, and I'm still gonna, it's not even gonna be close. So it's kind of silly the way that it works out. And that's, you have to explain this to each person is, each one of these houses is an opportunity. What are you going to do with that opportunity? And this, what I'm showing you, is gonna be based on 5% annual appreciation. That's not taking into account your, uptowns or your, whatever the next area is that's gonna explode and have significantly more appreciation than 5%, right? Okay, now we're gonna do tax shelter, and then we'll do cash flow. Now, there's a lot of little, again, when I do this pitch, whenever I get to a tax shelter, I always tell people, hey listen, I'm not an accountant. Tax code is voluminous, it's massively large, and every accountant looks at it a little different way, has a different risk tolerance. Make sure you talk to your accountant about this, but everything we're talking about is regular, normal, conservative write-offs, okay? So, the first big one is depreciation of the asset. Is anybody here familiar with depreciation of the asset? Okay. So if I'm a builder, just to make clear, if I'm a builder and I go out and buy a bulldozer, the government wants to incentivize me to buy that bulldozer because it's very expensive. And so they allow me to take a percentage of the value of that bulldozer every year that I use it and write off the value that I lose from the use of that bulldozer against my income. So if I have a $500,000 bulldozer and I get a $100,000 write-off, my tax bracket is 30% for purposes of this. Again, I didn't take any taxes over here. For purposes of this example, it's 30% on $100,000. I would get to take $30,000 that I would have given to the government, and I get to keep it in my bank accounts, right? That's great, okay? Same works with rentals. When you're a landlord, a rental is a capital expenditure. And so you get to depreciate single-family residential assets at what they call 27 and a half years straight line. Now, I'm writing this kind of small. I would write it bigger if I was working with a group. Just for you guys, that's what it is. And what that means is you take your total cost in the asset, all right, and you divide that by 27 and a half years even. That's what straight line means. It's the same every year, okay? So what's what they call in tax world, what's our basis or our total cost in this property? $215,000. Now, this is why we buy real estate. The government makes you take out 20% for the cost of the land, because land is not a depreciating asset, okay? So they don't allow you to depreciate the land. So that's $43,000. So that's, what, 18 grand off of 200 is gonna be 182. So your basis, I'll do it up here, basis equals 182, okay? So anybody have 182, get calculator, give me 182 divided by 27 and a half. It'll be like 7.
Can't you accelerate depreciation using the
You
cost?
can, for sure.
It's
So,
about two.
Yeah.
what is it?
No, I'm saying you said 182 divided by what?
27 and a half. So he's saying, can I take more of the depreciation up front, or can I not take it up front and save it for later? 100%. And this is one of the great things about these assets. And I would tell somebody, yes, you can, but I would check with your accountant on how you want to do that and make sure you know the details. But here's the thing, if you have a big year and you go flip 10 of these and you make $230,000 and you're in a 40% tax bracket or 30% tax bracket, that's 75 grand. Well, if you have 10 of these rentals as well, guess what you're paying in taxes? Nothing. You can accelerate, you may not even have to accelerate with 10 rentals. You can just cover that gain. So gains in real estate can be covered by shelter in real estate, all right? So What was 27 and a half years going?
6618.
6618. So that's a, let's just say 6600, and we're going to use 30%, right? So 10% is 660. So 61218 and 61218 is roughly $2,000. Okay, so that's your first write-off, $2,000. All right, and that's all the basis that you have in there. Does everybody follow that? So that's appreciation of asset. These are also considered expenses in the course of business. All right? So if you have your 50K and your 7,500 and your grand, that's 58.5, that's 59, that's 63, that's 64. Let's just call it 60 grand in expenses. All right? This is part of the reason what you're talking about. Those can be taken at different times. I'm going to divide them over the 5 years evenly just to kind of show the kind of tax shelter that's created. So if you have 6 grand divided by 5, it's $12,000 a year times 0.3. It's $3,600. So let's just call it $3,500 annually. Okay. Now you can also take a write-off for all the interest expense on the note. Right. So in this note, if you're going to refi, and let's say you do it at 80% of your value, or the 212 does it at 75. So 80% would be what? 200, 75 would be 187.5. Your note at 187.5, okay? I'm going to write this out so you can see it. Is going to cost you roughly 1% a month, give or take. That's you're going to be a little less than that, right? But that's $1,875. So let's just call it $1,800. For the first 10 years of a note, definitely the first 5 years of a note, 10% of that goes to principal, 90% of that goes to interest, taxes, and insurance. You guys are familiar with the pity payment, right? Okay. So if I take 180 or 10% that goes to principal that I don't get to write off of that, let's call it $1,600. That's $200 off. Okay, so $1,600 is your interest, taxes, and insurance. You pay that every month. Multiply that by 12. That's 16,000 and 30. Yeah, 32. So 19, let's call it, times your 30% tax bracket. It's another, what, call it $5,800, is that right? 1, 2, 3, 9, 18, 27, $5,700. So there's another $5,700 a year that you're able to write off. So every year, and this is just these three, right? It's not your car expense, it's not your computer expense, it's not your phone expense, it's not all that shit, other stuff that you can write off, right? 5,700 and 18 is going to be 67. Call it 75, 8, 11, 13, okay? So that's 13 grand every year that you would have paid to the government, that you don't have to pay to the government because of this one little house. And that may not seem like a lot, but when you have 10 of them, and it's 130K that you would have paid to the government, that you no longer have to pay to the government, man, that's a whole lot better, right? So besides equity capture, besides tax shelter, we have two others that we're going to look at. You have cash flow, all right? We said our payment's going to be about $1,800. What's your rent on a $250,000 asset these days?
2,000.
25.
2,000. Let's be conservative. Say 2,000. Okay. So if you really want to be conservative, 10% goes to the property manager. You pay your note off. You got no cash flow. Property pays for itself. But you also have a situation where you don't really have anything invested in this property. In other words, if you can refi at 75%, that's 187.5, right? Okay. You said your total in this property is only 15 grand. Okay. So what do you have, 17.5 in there? So you're getting that back pretty much the first year just off a tax shelter. Pretty much at the end of the year, you're net $0 pretty much invested in this property. If you can refi at 80%, you're almost definitely $0 invested in this property. Or if you can keep your rehab a little bit lower and refi at 75, you're almost $0 invested in this property, right? And we all know that most rentals, you can do a little bit less than the buy, fix, and sell budget that we're gonna do. If you get those rentals that they need everything, well, there's a positive and a negative to that. You're gonna have to spend the whole budget, but you're not gonna have to mess with it for the first 5 years because everything's gonna be brand new anyway. So your maintenance is gonna be very low, all right? So, equity capture, tax shelter, cash flow, somewhere between 0 and $2,500 a year, right? So let's just say cash flow, 0. You good with that? All right? What about appreciation? We're gonna say 5% a year for the first 5 years, that's 25% non-compounding. What's 25% of $250,000?
10 grand.
So 25, right, so 10% would be $25,000.
Yeah, sorry.
You're good, $50,000 and then another 12, so 62. So you got, let's just say 60 grand in appreciation. So at the end of the day, between your equity capture and your appreciation, you have 95 grand. With your tax shelter, you have another 13K. So that's 108. So let's just say you have somewhere between 100 and 110K that you're gonna capture in the first, we didn't even do 5 years, I'm sorry. This is 13K a year, right?
Yep.
So times that by 5 years, that's $65,000. So 65 and 60 is 125, and another 35 is gonna be 150. So let's just say you're somewhere, if you wanna be super duper conservative, between 100 and 150K annually, over the first 5 years in profit on this deal. And really it's 150 grand. But sometimes people are like, man, that's crazy. How can you do that? I'm gonna make 46, 50 grand at 20% appreciation a year, and you're gonna dust me at $150,000, or roughly 3 times that over the same time period. This is a business. It is about how people should be spending their money and where they should be investing. And one of the craziest things about our industry is people constantly undersell the value of residential real estate and what you can do with it. If you go and look at any of these magazines where they compare the New York Stock Exchange to what real estate's done over the last 20 years, they take into account appreciation and appreciation only. They don't look at tax shelter, they don't look at cash flow, they don't look at leverage, they don't look at the fact that essentially if you wanted to wait a year, and that goes up 5%, okay? That's $12,000, that's $260, and you wait a year and refi out at 80% at $260, and now you take $208 out, you got nothing invested in this property. So the pitch is really, and this is, wrap your head around it, you walk up to people in the office and you have your little conversation with them and you go, hey man, if I could show you how to take 50 grand, put it into a property, and 12 months later, get that 50 grand back, still own a 3-2 house with 20% equity that has tax shelter, cash flow, appreciation. Even if you have 0 cash flow on day 1, by the 3rd or 4th year you have cash flow. Because the rents go up every year. This is a fixed payment, it should be. It's inevitable. So you're able to invest in something that you have 0 skin in the game. You have no cash in it because you've refied out. You don't want to take a cash out, which means that you're taking more cash than you put in, because A, well, you shouldn't need it, and B, you want to keep that interest payment as low as humanly possible, right? So that's a great investment. If I can put 50 grand into it and a year from now get my 50 grand back and still have cash flow and equity and appreciation and tax shelter, that's a no-brainer. But it's got to be explained properly. This is part of it, okay? And then educate them on what it is and how easy it really, the buy, fix, and rent buyer is better than the buy, fix, and sell buyer for multiple reasons. One, they'll pay more. For this buyer, 5 grand more is $50 in his mortgage payment every month. For your buy, fix, and sell buyer, 5 grand more is $5,000 out of their pocket in 4 months. It's a big difference. If you go from making 23 to making 18, but if you go from making $200 a month cash flow to $150 a month cash flow, that doesn't matter. And if your net at the end of 5 years is 145 instead of 150, that's not really that big a deal. And when you get to the end of the line and you actually pay this note down, then it matters not at all, right? Buy, fix, and rent is an easier play than the buy, fix, and sell. Everything doesn't have to be perfect. You don't have to worry about if your tenant moves in and your air conditioner breaks and leaks on the ceiling and the ceiling collapses, and God forbid it hurts their clothes, not a person, you're not going to get sued for that. You're going to get a call and you're probably going to have to pay for some clothes. But if you sell that house to someone and that happens, you can almost guarantee you're going to wind up with a lawsuit. Buying, fixing, and selling is just riskier inherently than buying, fixing, and renting. And unfortunately, people go, $23,000? Oh my God, $23,000? That's amazing. They don't see that when you do a rental that there's any immediate payment, like lump sum payment. So the human brain goes, oh man, I need that microwave money, like that, right? Show them how, if you're just patient, that over the course of 5 years or 10 years, you can build an amazing amount of wealth. I want you guys to meet somebody. So I'm going to stop this here real quick. Does anybody have any questions on this? So it's funny. Yeah, please.
So they don't get that money back like right away, right?
What
It's
money?
more like that. It's more kind of like a long-term investment that
That's
like
over
tax
5 years.
write-off.
5 years.
Okay.
Okay?
But do they actually see
They
that
do
money?
get most of this money back right away. So with 212, they will refi you at 75% of 250 at 60 days. So you can either get most of your money back, or you can try to be conservative up here and get all your money back. To refi at 80%, from what I've seen, you have to have a seasoned property. It has to be owned for more than a year. They want to see it to be stabilized before they give you 80%. Because in many cases, in some cases, that's going to be a cash out. Someone's going to be in that rental property, especially at $100,000, $150,000 property in not the best neighborhoods. You can be in those at 75 cents on the dollar all day long. So they're not going to give you an 80% refi until you're there for a year. But you can pull out most of your money between cash flow and refi at 75% after a year. Or after 60 days. You can pull out 80% after a year, in which case you should have almost all of it pulled out.
Price is a value, it's not like,
Yeah,
they're gonna, yeah.
Well,
It's on paper.
The beauty about it, doing it in a year, if someone's able to wait, it's kind of like a farm, right? You have your grow and your rehab, you have your flower, and then your harvest a year out when you can refi 80%. This is going to be 260, 270.
Yeah, it's just gonna go up.
Yeah, so it's going to make it easier to get their money out. Any questions?